Hello friends, my name is Behroz. I'm a finance executive by profession and welcome to my channel where I talk about financial and career success. Now in today's video, I will talk about a very smart and cost-effective way for you to purchase a house in Canada. This is through using the FHSA account. Now with this account, you can approximately save somewhere around $30,000 or even more depending on where your tax bracket is and how much you contribute to this account. However, you can save approximately $30,000 which you can use towards your down payment against a house that you are purchasing. Now make sure that you stay tuned till the end of this video because I will also be sharing towards the end of the video the calculation behind this $30,000 number so you understand how much you can save using this account and you can use it towards the down payment of your house. Now before moving forward, I have to ask for you. One, press the like button, and second, subscribe. This is for free, no charge to you. However, this would mean a lot for me in order for me to improve the quality and the quantity of the content that I post on this channel. Now let me talk about what FHSA account is about. It stands for First Home Saving Account. It started in 2023 and the idea was to encourage saving towards buying your first home, but not just encourage saving, but also to help you financially in order to buy the first home. And as I said, using this account, you can easily generate around $30,000 of extra money that you can use towards the down payment. And as I said, I will explain more on that number later. Essentially, what you do is you have this registered saving account in which you contribute money, and the money that you contribute in this account in that particular year, you don't pay tax on that particular amount that you're contributing in this account. And it is not only that you don't pay tax on the amount that you contribute in this account, rather the amount that is in this account, when you invest that account and you earn any dividend income or any capital gains on that account, you don't even pay tax on that money as well, which means all your gains on the investment that has been done with the money in this account goes tax-free, which is a major advantage. Here, note, like everything else, there is also a limit to how much you can contribute into this account. At any given point in year, you can only contribute $8,000 in this account. And in totality, you can't contribute more than $40,000 in this account, which essentially means that you can contribute $8,000 in this account for 5 years, which means by the end of 5 years, you would be $40,000 in, that is, you would have contributed $40,000 in this account. However, as I said, when you contribute this $40,000, which is $8,000 every year for 5 years, you don't pay any tax on it. Also, when you invest this $40,000, any income that you earn, you don't pay any tax on that capital gains or income that you earn on this $40,000. So that all goes tax-free. Let's say you invested $8,000 in year one. However, towards the end of year one, that $8,000 becomes $10,000 just because of capital gains and because of income earned on the $8,000 that you invested. However, that doesn't mean that your contribution room will shrink. Your contribution room has only shrunk by $8,000, which is what you contributed in first year. In second year, you can again contribute $8,000. Third year, you can again contribute $8,000, and fourth and fifth year as well. Essentially, that means is that even if you've contributed $40,000, your total size of the investment and including the income or the value of your account can go above and higher than $40,000, and it will not be eating from your contribution limit, which is $40,000. Here you only have a limit to the amount of money you can contribute in this account, which is $40,000. However, there is no limit to the amount of money you can earn in this account by investing those $40,000. Now, how do you go about opening an FHSA account? You can do so by opening with any online broker. One online broker that I highly recommend is Questrade. I use them personally and I like them a lot. If you are interested, I will leave the link. And if you use the link, you can also get a $50 credit in your account when you open your first account. So check them out. Now, another good news is that you can also contribute in this account through RRSP transfer. So for instance, if you don't have money in a particular given year to transfer in this account, then you can transfer through the RRSP money that you have. However, in that case, you won't get any tax benefit because you've already taken the tax benefit on the money that you contributed in the RRSP account. And now this is just a transfer from RRSP account to FHSA account. So there won't be any gain in terms of tax. However, the good news is that your limit in the RRSP account doesn't get reduced. So for instance, if your limit in the RRSP account is, let's say, $10,000, if you move $5,000 from RRSP account to FHSA account, then you have extra $5,000 room in RRSP, which you can contribute at a later date. So essentially the idea is if you can't contribute money in this account today through your own pocket, then you can move money from RRSP, which means you won't be taking the benefit of the tax saving. However, once you bought the house and once you have money later, you can always contribute back to RRSP and take your tax benefits later. So it's just like you pushing the tax benefit to outer years as against taking that tax benefit now. Now let's talk about the eligibility. Anyone who is a tax resident of Canada and has not purchased or not lived in a principal home for past 4 years. So let's say if you had a home and it's been 4 years that you are renting a house, you will also be considered as a first-time home buyer. So you just have to have a gap of 4 years since you last owned a home, a principal home, or your partner owned a home. Once those 5 years are done, then you can be eligible for this particular account. Now, when can you take out money from this account? You can simply take out money from this account when you're making a qualifying purchase. What is a qualifying purchase? The qualifying purchase is that if you've not owned a principal residence for past 4 years and you're going to purchase a principal residence now, then you can take out money from this account. Also note that you and your spouse will need to have two separate accounts, and once you're buying, let's say you're buying a house together, then you will take out this money from those accounts and then combine the money and then make the purchase. Now here note, in any given year when you are withdrawing the money, make sure that you are going to purchase the house in that year before 1st of October. If it's after 1st of October, then you cannot withdraw the money. You will have to wait till October for you to withdraw the money for it to be a qualifying purchase. Also, you should not have purchased a home more than 30 days before the withdrawal. So let's say you purchase a home, so immediately take out the withdrawal from this account or take it out within the first 30 days of purchasing your home. If it's after the first 30 days, then you are not making a qualifying purchase and your money in this account kind of gets useless. Additionally, make sure that whatever house you purchase, you are required to occupy that house within the first year of making the withdrawal. And second, the year in which you make the withdrawal, make sure that you close down the account by end of December 31st of that year. Now let's quickly talk about the calculation. The number that I shared with you earlier, which is around $30,000 worth of money that you can generate using this account, which you can use towards your down payment. Let's understand how that money can be calculated for you to have a better idea how important this account is. And by the way, if you and your spouse have different accounts, then you add those savings or those benefits together and it would be somewhere around $60,000 worth of benefit that you can earn by investing in this account. So here are the numbers. Let's say our marginal tax rate is 45%. Marginal tax rate is the tax rate bracket that applies to any incremental income you earn. So if you have $40,000 invested in this account, you can simply save $18,000 in your taxes, which is 45% of $40,000, which you can use against your home purchase. Now, let's say you also invest this money as you're contributing for every year up to 5 years. If you invest this money at a rate of 10% return, which is the return that you can get from S&P 500 investment, then you earn $14,000 on top through investments only. So $18,000 from saving tax and $14,000 from investments. These two together add up to make $32,000. And if you keep this money invested for a full 10-year period, then the amount that you save can be as high as $65,000 only coming from one account. Imagine if there were two accounts, then the money that you save or generate by investing in this account can be as high as $60,000 or $130,000, depending how much time you give the money to grow in this account. Thank you guys for watching this video. Hopefully after watching this video, your dream house is a step closer for you to purchase. Just by using this account, you can generate more money and then use that money against the down payment for that house. In case you enjoyed this video, I'm sure you'll like another video on my channel where I talk about how you can go about saving taxes in Canada. You can check it out here. Other than that, there is another video where I talk about comparison between DCPP, RRSP, TFSA, RESP. Which one is better for you? You can check it out here. Thank you.